Building a financial calculator in Google Sheet is no rocket science. You just need to do a bit of formula linking with the cells and then you are ready with it. A basic background on corporate finance will tell you that, let's say you're investing some amount of money and you are expecting payoffs from those investments. So you just need to put that stream of investments and payoff, and if you just add them, you'll get the net cash flow. So column B represents the amount of money which you're putting in the project. Column C represents the amount of payoff which you're getting, and column D is the net cash flow. Now, few things over here. Period 0 means the current period. So at the beginning of current period, you put in this investment. Essentially, you will wait till the end of the 12th period. So you will have to spend 13 years to get your entire payments. What is the interest rate or the cost of capital as of now? That you can put in over here, 10%, 12%, 5%, whatever the number which you feel is right or sensible. Now, how do we calculate the net present value? To calculate the net present value, what you need to do is the first cash flow which you directly need to add is your initial investment, which is your this number. And just for the sake of symmetry, I have used this number minus 20,000 because essentially this is a negative cash flow, right? So I have just made an addition over here and just use this negative cash flow number. Now, the moment I add this number, I also have to do the time value calculation for the future payoffs and the future investments. So these guys will be entered into the NPV formula directly. So if I look at the cell G2, you can say that the first component is the initial period's cash flow, and obviously it's a negative cash flow, and the second component is the NPV formula, which takes into account the current interest rate, which is linked at G1. And the next thing which this NPV formula will take is the stream of cash flows, which is from here, D3 onwards till D14. So this will give you this as a net present value. Now, there's another thing which you can do with your stream of cash flows or rather stream of payoffs. You can also calculate the internal rate of return. I will obviously make videos on cost of capital, net present value, and IRR, internal rate of return. But still, I just have to calculate it for the sake of this financial calculator. So how do I calculate this? Directly put in the IRR formula in Google Sheet. So IRR will take the stream of cash flows. So select all the cash flows. Now cash flows is from D2 to D14. Now just remember a few things over here. In NPV you selected from D3, but in IRR you have to select from D2, right? Now we also need to validate our NPV calculation and IRR calculation. How will you do that? IRR is that interest rate. If you supply this interest rate to your cost of capital in NPV calculation, this will change the NPV to 0, because just understand, NPV is dependent upon your cost of capital. So if I change the cost of capital, my NPV will change. So the definition of IRR is such that it is that interest rate which when entered into the NPV formula makes the NPV 0. That is why I have made this IRR NP validation thing over here in H2. This returns a 0 NPV when I use G3, which is our IRR as interest rate. So this was a pretty standard sheet to calculate net present value and internal rate of return. And essentially you can also do reverse kind of calculations. If let's say I give you that this is the internal rate required, so what should be my stream of cash flows or what should be my cost of capital? I mean, there are many things which you can do over here. I mean, it depends on the problem at hand. But let's move on to the next part of this financial calculator, which is the periodic payments part. So again, I'll start with the assumptions, which is the same. The current year starts at t equal to 0 and the number of periods is the terminal period plus 1. So terminal period is 12 again. So 12 plus 1, 13 periods, right? And let's just first understand, what if we pay 9,000 per period? What will be the future value of these payments, these 13 payments? So you can directly use the FV formula, or the future value formula of Google Sheets. And if you want to look at the syntax, the first will be your interest rate again, E1. And just to give you a clearer picture, let me directly go to the official future value documentation. So the first is your rate of interest, then number of periods, then your payment amount, and the next two are optional. Present value, you can directly put it to 0, end or beginning. For our case, it's beginning, so I'll use 1 over here. So that is why in the formula you can see 1 over here and 0, because this is an optional argument. This is the current value, current present value. So current present value is 0 because we are starting the investment as of now, right? So in that situation, what will happen is this will give you the future value for your payments. Now I can also validate the future value by using our simple geometric progression formula, because if you're making periodic payments and the cost of capital is a constant 10% or 5%, some anything like that, then you can convert this cost of capital or current interest rate to a growth rate, right? Now the growth rate is essentially your 1 plus interest rate. So using this growth rate, you can directly calculate the sum of geometric series, and that should be equal to the future value. Now what about the other way around? Let's say you know that you want this future value in cell D6. Now I have directly linked D6 to E2 just to give you a kind of a transparent understanding that if A is equal to B, B is equal to A. In this it happens like that. That is why I'm using this payment to calculate this future value, and again using this future value to give you that if we do the back calculation, I'll get the same annual payments, right? So if let's say I desire this future value, now how do I get what should be my current payment structure? How much should be my periodic payments? So I'll directly use the payment function PMT. Now even here the working is very similar to your FB formula. First again is your interest rate or cost of capital, second is your number of periods, and then you have your optional arguments. Now over here you can see there is a fourth argument, D6 is your future value required, and again the last one is for end or beginning, and I choose the beginning thing. So you see there is a lot you can do with Google Sheet in the realm of financial calculations, and I would like to make similar financial calculators in other platforms as well. So if you like this video, do give it a thumbs up, and do not forget to subscribe to this channel if you haven't already, as in this channel you can find content related to finance, economics, data science, maths, and any kind of knowledge.